We exist in complicated, difficult markets. This is not California. Are we really capturing all the information accurately? So
joining me on the couch is a venture capitalist. His name is Khaled Talhouni. He's the managing partner of Nuwa Capital. I have always been very impressed with what the Egyptian startups look like. I think they have some of the best founders.
This is going to get me into trouble because my two partners are women.
You obviously determine where you make that money. Welcome to today's episode of Couchonomics with Arjun. Joining me on the couch is a venture capitalist. His name is Khaled Talhouni. He's the managing partner of Nuwa Capital. And we've actually never met in person. So this is the first time I'm actually meeting Khaled in person. We exchanged a few messages. And as you know, in some of the previous episodes, we've talked about, the role of venture capital and how it's actually shaping not just the fintech, but the broader sort of startup ecosystem. I thought it'd be a great idea to bring a VC right up front at the start of season 3. So with that, Khaled, welcome to the couch.
Yeah, thank you very much for having me. And like we were saying a few moments ago, I'm a huge fan of the show, so I listen to most of the episodes, and thank you for having me.
No, I appreciate that. I appreciate it. Even if you don't mean it, I seriously
I sincerely
appreciate
do. No.
So Khaled, let me start with some sort of numbers, right? For 2023, which to me was not the best year we've ever had in venture capital, right? So I'm going to share some numbers which I think are in the public domain. You'll recognize these. I think the point of all of this is that I have some very pointed questions at the end of the day, right? So roughly what the numbers say is about $4 billion were raised through venture capital, which included debt, which, to be honest with you, most of it was working capital debt, which a lot of BNPL players raised. Sure. So it was not even convertible notes, from what I understand. If you take the debt out, startup funding dropped about 35%. And to be honest with you, a lot of that was rescued right at the end of the year, because I think November and December alone was about 1.8 billion, right? I think
mega deals also, much larger deals.
Exactly. Yeah. And there were sort of 5 mega deals. I think Tabby, Tamara, Nana, Flowered, and MTN Halan. I think they made about $1 billion. And then, Saudi emerged as quite an interesting participant. All these 5 mega deals are sort of Saudi companies. I know Tabby moved to Saudi during the year, but they are a Saudi company. So if I take a step back, and I've got a number of other stats that I want to start with pointed questions. Your view on what is the state of the nation as we end 2023 and enter 2024 for venture capital?
Sure. So I think obviously there was a market decline in the availability of and deployment of VC in 2023, and it's really started in 2022. I think the data is indicative, like you said, there's some distortionary impact by whether debt's in there or not in there, and then are we really capturing all the information accurately? But I think it's safe to say that there is anecdotally, and just from being in the market, there is kind of a contraction. So I don't necessarily think that's a bad thing in the grander perspective. So if I look at VC, and I've been doing this for the past 16, 17 years, primarily in MENA and Turkey and a little bit Southeast Asia. I think if you look at this market and you rewind, you think of it in slightly longer time horizons than kind of annual time horizons. You'll see we went from basically, in 2015, 2016, something like $300 million of VC deployed across the region to anywhere between 2.5 to 4 billion deployed, last year, which includes debt. Remove debt, probably closer to 2.5 billion. So for me, this is about an overarching trajectory of the availability of venture capital rather than annual swings in that number. Because you think of it in terms of for us as VCs and as investors, it's like the cohorts of company formation. There are companies that are formed over 1, 2, 3 years, and they raise money over that period. It's not sort of singular. So think of it in annual increments is not super, it was the only thing we have at the moment, but it's not super useful in terms of gauging the overall trajectory. I think one way I think of it is when you're on an airplane and you're going through turbulence, it does feel like going up and down quite violently. But if somebody's looking up at the plane from the ground, it's just kind of rising quite gradually. So I think there's something of that dynamic that's going on right now. I will say that in the 2020 to 2022 period, I think that was an aberration. I think we're looking at more of a reversion to the mean in terms of the velocity of the deployment of VC in companies. And I think over time, the availability of VC will undoubtedly increase. Whether 2024, it will remain flat or decrease a bit. But if you take a longer time horizon, I have no doubt that in 2027, 2028, the availability of VC will increase significantly because we're massively underpenetrated in venture capital.
Yeah, and I guess that's the point, right? So what, with all due respect, we can sit here, pat ourselves on our back, and say, the plane is going up, but there's only one way to go because, as you said, we started with a very low base, right? A couple of questions which come to me, and these are by no means validated by data, but just by conversation, right? I don't believe that there is a shortage of deployable cash, if I may say so, right? So there's no shortage of dry powder, as the term goes, right? The other point I've heard is, well, the deal flow doesn't exist, right? I don't know if that's true, but I want you to pick up these points independently. Thirdly, yes, there was a spike in I guess 2020, 2021. In my humble opinion, it was a lot of sort of just FOMO combined with let's just follow the pack, right? And just keep deploying. And again, even during that period, most of the deployment was still quite concentrated with a handful of players, right? And then you add one more sort of factor to that, which is fintech, right, is a disproportionately large percentage of, forget the 4 billion, but even whatever the minus debt side is, right? And we should see startup growth across the spectrum, specifically because the economy is trying to diversify, so on and so forth. So pick on all of these for me, and if I'll repeat them if you can't.
that's a lot of things
I
to
know,
pick up on.
but I think that's what I think that's what the listeners really want to hear about it is. So firstly, there is no shortage of deployable dry powder. You guys have pulled the hand out of the market, or have your LPs gone and said stop deploying?
Yeah. So actually, so from our experience, we have initially $100 million fund that's mostly undeployed. And actually, we pulled back when the market was hot. So in 2021, we did the first close of that fund in 2021. And by the end of the year, we took a decision to say, we're halting and we're going to really take this slow because we couldn't make sense of the entry valuations. But more importantly, the velocity of the investments. I think nobody was actually... If somebody's calling you on a Tuesday and says you have to close by Friday and you've just met that person, then really you're not really investing, you're just deploying and there's no due diligence there involved. So that's
what scared me. Why were your peers doing it? And I'm sorry, I'm going to put you on the spot, right? You guys are a small community. Most of you know each other, right? I know most of your peers. So why were the others doing this?
We did a bit of it too until we stopped, because I think human psychology is wrapped up in this idea of a herd mentality and FOMO. And you don't want the VC model also lends itself incredibly well to that, in the sense that you're doing, you're following the power law, meaning you're going to find a small number of companies that if you find the right one, right, it's going to disproportionately make or break your returns. And so if everyone is deploying quickly, then your sense is you're going to miss the next big one. So that's kind of what's the driving psychology underneath it. So I think that's kind of what was going on. We did it for a while, and then we went, we're not gonna play this game. I'd rather wait till the market tips, and I think we were validated. The market tipped, so we're mostly undeployed now in our third year. So we deployed only 40%. Our LPs actually were pushing us more to deploy at that time, saying, "Oh, you're really undeployed. You're really undeployed.
Otherwise, give me my money back. I'll do something else."
Yeah, exactly.
With it, right?
I think it was you're mostly undeployed while you're moving slow was the more common refrain. Thankfully, our LPs we have about 17 in this fund that are they're quite supportive. So nobody went okay, stop. This whole market's screwed. Nobody went like that. So we're quite lucky. In that respect. So there is, to kind of back to your question on dry powder, the way the VC industry from 2018, 2019, when the sovereigns entered the market, changed. The sovereigns entered, and they encouraged the private sector to enter as well, or the kind of the families and corporates to kind of become allocators. So you had a kind of big jump. As part of that process, that kind of shaped the market a certain way. So the VC market today is deeply fragmented. There are no large players, really. There are no large, so non-sovereign VC firms, right? Like who has, the largest AUMs are probably over multiple funds are $400, $500 million. And this is for the oldest firms that have been in the market for 10, 12 years. So the market's deeply fragmented. What that means is that there's an over-indexing on early stage. So there's a lot of people who can write the $3, $4, $5 million checks and not break their portfolio construction, meaning they don't over-allocate to a single fund, portfolio company. But there are very few funds that can lead and write a $10, $20 million or $30 million check. So if you're at the early stage, you're raising $1 to $5 million, there's a lot of dry powder, it's available, you can go get it. If you're in the cohort of companies that graduated between 2019 to 2023, when you raised the seed or Series A then, and you're now looking to raise a 10, 20, $30 million Series B, it's very hard to do. And historically, how it's been done is you basically raise a number of nested convertibles on top of each other, and you sort of cobble together around, but nobody can lead there. So, to answer your question, there's dry powder, but it's stage dependent a little bit.
No, it's right. Yeah. And if you look at the numbers, if you look at, if I had the early stage, which is grant, angel, pre-seed, seed, there are hundreds.
That's happening.
Right? That's like 400, 500 such investments have been made in just 2023. It just falls off. There's a bit of a blip in the middle,
and then largely picks up again.
Because those are the guys who picked up, the late stage, the Tabis, Tamaras, and so on and so forth. But the whole middle rung, which is where I personally think the health of the ecosystem is determined,
is a bit
because
empty.
There's a bit the top end or the front end. We all know there's going to be washout, right?
Exactly. Yeah.
Whatever the success rate is, I don't know, 1 out of 10, 1 out of 90, 1 out of 100, whatever the number is.
And it's usually in other markets, other emerging markets, A to B, Series A to B is like 4 to 7%.
Yeah.
So that's
so and then I think we just need, and I think that correction is essential to actually create a healthy system, right? Let me get to the second question, right? If I may ask a very simple question, have the VCs learned anything out of this experience? In sense of, I've seen some great VCs write to founders on what they should learn and what they should do differently. And I will come to asking you at the end of the show, what should founders do differently if they're looking to raise money? What have the VCs learned out of this exercise, or this period that we've gone through?
Well, I think it's a deeply humbling experience, right, for a lot of VCs. Have they learned these lessons? Are we going to go through another bull cycle and we're just going to throw money around? Probably. I mean, just because, like I said, the nature of the VC returns model is you have to find the next big company. And if people are throwing money left, right, and center, that means you may, there's an off chance you may miss the next big thing. Your incentive is to throw money rather than not. Unless it becomes very abundantly clear that everything you're throwing money at is just doesn't make sense. So I expect it'll be hard for VCs to learn the lesson in the long run. Everyone will say they did in the short run, but in the long run, it is quite hard.
Because I think became quite apparent to me, it was a little bit like, find the lead investor, you trust the lead investor, just cut the check, right?
Yeah.
Irrespective whether you had the domain experience or not. And I agree with you, whether it's Tuesday to Friday or it's Tuesday to 3 Tuesdays away, if you really don't have the domain experience and you really don't know how to actually vet the asset properly, time is irrelevant, right? I think the question you're asking then is, who's cut a check for you? And if a particular name or particular names fall out and say, yep, they've cut a check, then your logic was right. What are you looking for? $500,000? Great, I'll cut one and give it to you because I'm going to ride the wave, right? Let me come to a point around the rise of sort of Saudi Arabia, right? If you really look at it, there's been a massive shift, and I was kind of looking at some numbers. I'm sorry, I'm getting old, so I have to write these things down now, right? I think so. 100% of the mega deals were all KSA, right? I think KSA grew year on year, right? Obviously, the mega deals helped, right? UAE took quite a big hit in terms of the drop in investments, right? Across the board. I just don't mean fintech. UAE went down from something like 1.6 billion in 2022, which wasn't a great year either, to 0.6 billion, except the debt. Egypt has certain systemic issues, so let's not blame Egypt. Do you think this shift is permanent now?
So
towards KSA?
Just to kind of like throw a wrench in this, because I disagree with the premise of what is a Saudi company versus a UAE company versus another company.
Fair enough.
So
they're all regional companies.
There are certainly local companies for sure. I mean, that are kind of really speak to kind of local infrastructure heavy, whether soft or hard infrastructure driven stuff. So fintech tends to kind of fit within that because it's very regulated. But on the whole, and this is, we construct our thesis like this. What is the definition of a UAE or a Saudi or Egyptian company or whatever company? I think for our region to achieve true scale, to achieve true kind of disproportionate outcomes, like a Kareem, like a Souq, like, these really kind of outlier types of exits, you need to be pan-regional, multi-market rather than local. Some good exceptions to that, for sure. Tabi is another, it's a regional business. We say it's HQs in Saudi, but it addresses two major markets. Also tried Egypt, right, for a long time. And then, so I think we should conceptualize most of these companies as being regional rather than local. Within certain definitions, the most important, most of the operations or where the capital will go, whether the company is HQ'd in UAE, the plurality of capital and OPEX, etc., will go to Saudi because that's the largest single market in the Arab world, right? Or in the Middle East. It is the largest consumer economy. It's the largest GDP.
So you're basically saying it's following proportion.
Yeah, proportionately, it is pluralistically the largest. So naturally, if you define that as a Saudi company, then that kind of makes sense. But in reality, with some exceptions, particularly in some fintech, and you have Jahez famously,
food tech,
they tend to be regional businesses, and I'm not sure how useful it is to think of them as UAE versus.
So let me give you where I'm coming from, right? So I completely subscribe to your view that in a region which is as small, and let's be honest, all of them cumulatively, if you take the oil economy out, both from a consumer and a commercial perspective, there isn't that much to go around. You have to look at it regionally, right?
Yeah, not to, because I think we can make great outcomes, great businesses in our region, and I'm sometimes criticized for saying this, but I mean, the size of the MENA economy is the size of the economy of Spain plus, bits of Provence, so it's not that large, really.
Well, that's the point. I didn't want to make it that.
But
stark.
I think people don't like when I say it. But that's not to criticize. That's not to kind of belittle what we can build here. We can build amazing, great companies, but to do so, you should aggregate these markets if you can to get to bigger and better outcomes. You should even add Turkey if you can. Because we do that, so we really kind of try to add Turkey as part of that. Then you have a sizable economic bloc where possible. So I really try to evangelize for this idea, with the added proviso or caveat that the single largest economy is Saudi. So you can't have a scalable business without Saudi, right? But you can have an even bigger business if you aggregate the region as a whole. So that's kind of like the thing. Most important is Saudi penetration, accessing the Saudi market. But add beyond that, then you have a big block.
And I'll give you a view, right? And this is sort of slightly sort of my view in terms of how I see the region evolve in the future. And I know I'm 100% wrong, but I'll still say that. I think, as you said, there is MENA, right? There is a very interesting country in Pakistan. Yes, unfortunately, it's going through its challenges, but it's a large country with potential, and hopefully things will get better. You talked about Turkey, again, going through a certain amount of challenges, but very attractive. And then you have all the, the erstwhile sort of Russian countries, which, if I may call, are sort of, the Turkmenistans, the Uzbekistans, the Central Asia companies, which actually you could argue might have more in common, right?
In some ways, yeah.
In some ways with this. So you aggregate this into some sort of a convoluted region as far as geography is concerned. I think there's play. I think the reason I'm actually talking about Saudi versus I guess a particular country, and I'm not sort of picking on UAE here, is it's basically the switch on the mindset of the founders to say, where should we go and set our business up first, right?
Yeah.
And so for years, we obviously, UAE, and in UAE, Dubai was the place to come, right? Because you basically said, relatively favorable regulatory or sandbox environment, which DIFC provides, right? You have access to talent, fairly good talent, wasn't the world's best, but the best which was going around in the region, access to capital through venture capitals and some CVC funds and so on and so forth, and a small or a big enough market where you could sort of test and learn. And if you really look at Tabby, that's kind of how it started, right? The story started here. As a matter of fact, I know, but I think Tamara also, although they started Saudi first, I think they're
active here.
They were always active here. I think they grew faster here initially, but and then things happen. Now I will get corrected by Abdul Majid if I'm wrong, but we'll leave that for another day. I think my view here is, what the question I come back to you saying is, do you see going forward a shift of focus from startup founders, from VCs, all of you moving towards Saudi established businesses more?
Yeah.
That's the question, I think.
No, I think absolutely, and that's only natural. And I think part of what's driving that, I think, with the stats you mentioned, is, Saudi the past 3-4 years is like a sleeping giant being awoken, not to use an overused analogy. But, they've made a huge amount of relatively huge amount of capital available. Most importantly, they're doing a lot of soft infrastructure, whether that's regulatory reform, making it easier to bring in talent, leveling of the market. And in some ways, it's getting like very, very advanced, right? It's becoming an easier and easier place to do business. And given that it's the largest single market, it makes sense for it to kind of take that piece. I think the challenge in the UAE is that, well, Dubai in particular, because Dubai has historically been the hub, right? The regional hub, is the absence of capital, right? There is very little local capital here that can flow through the system. So if you compare to like a similar ecosystem like Southeast Asia, Singapore is the hub, similar to kind of like the role Dubai plays. And then the other kind of, primarily Indonesia is the largest kind of consumer market. And so, Singapore plays into that. But the difference is Singapore is very capital rich as well, between GIC, Temasek, etc., whereas Indonesia is not. So there's kind of this natural symbiosis. This is not the case between the UAE and Saudi, where actually Dubai has historically provided the soft infrastructure, but not necessarily the capital. But now, like, if it makes for an interesting dynamic where Saudi provides the capital, the consumer market, and the soft infrastructure. So I think the ecosystem will become a bit more in flux, but I think that's generally a good thing. I think the key being for founders to have a regional mindset. How do I optimize my business to access the biggest number of markets possible that are profitable, right? Yeah. How do I kind of work
and I'll be honest, and I totally agree with you. And again, I have a bias towards fintech because that's kind of what I understand better than other sectors. And I think we will go into other sectors because that's going to be my next question, or maybe my question after next. But I think there is also a regulatory challenge. I think we are very multipolar in terms of our regulations across, at least from a financial services perspective, right? Some level of harmonization would have made life a little easier for fintech startups, but that's not the case. And again, will that change? I don't know. I think there's lots of good multilateral conversations which the regulators are happening. We just need it to sort of manifest into certain things. Let me ask you a little bit of a question before we come into sectors, right? And we move away from just talking about fintech, because you obviously a very diversified fund, right? Is Egypt, right? I have always been very impressed with what what the Egyptian startups look like. I think they have some of the best founders. I had the good fortune of working in Egypt while in the UAE in business. I feel very bad for what happens in that country. It makes it very, very hard. One thing is quite proven. It's next to impossible now from anyone outside to go into Egypt and win for a number of reasons. Unit economics, local regulation, convertibility into foreign currency issues. What's your take on Egypt sitting where you are today?
So I think we've been fortunate enough to have invested in some really interesting businesses that are thriving in this, very difficult environment. So we invested in a company called Cylinder, which is a marketplace for used cars, where they kind of refurbish it. And this is, they kind of buy and then resell the cars and do a bit of refurb in between. And that is absolutely on fire. Doing incredibly well. We also invest in a company called HomeSmart, which is an online furniture business. So the omni-channel, online, offline. Half the businesses in Egypt and half the businesses in Saudi, but doing extremely well. And we also invest in a company called ID, which is a SaaS business for farms, but started in Egypt, but going to the world. I think in many, so we've been lucky throughout this journey. In investing in Egypt. There have been some kind of missteps, but generally I think it's been quite good for us. And historically it's been, quite good.
And your LPs are generally comfortable with you taking exposure in Egypt?
So I think of Egypt not dissimilar to the way I think about Turkey, meaning if you want to invest in these types of markets where there's there's a lot of turbulence around currency and around local market consumption, you should not, with some exceptions, do local consumer internet. Instead, you want to invest in businesses that can scale internationally and that have a B2B element, whether that's SaaS or can kind of leverage other networks. So and where an inflationary environment actually works for them, because as the currency reduces, your cost base goes down, but you're serving other markets. So I think there is a way to do that, to arbitrage that type of play. But I think it's you have to think of it from this context, meaning look at businesses that are scaling or about to scale in Egypt into other markets and have a reasonable way of doing that, where their cost base going down, relative cost base because of the currency going down, means that they can compete more effectively in that other market or other multiple markets. I think that's the play.
Okay.
It's the play for Egypt and the play for Turkey. The difference with Turkey is that in of itself, it's a large enough economy and you can still do more locally. But I think that's a similar play for all emerging markets where there's uncertainty on currency, which is a global issue, right? It's the same in Latin America. It's the same in some Southeast Asian countries. So like this is a well-trodden path.
Well-trodden path, but unfortunately in this part of the world, it all sort of focuses on Egypt because unfortunately the other North African countries have not yet sort of stepped out. I think we're starting to see some early signs in Tunisia, some early signs in even Morocco.
But Tunis has some good deep tech outcomes because they serve globally and don't think locally. Anyway, it's a tiny market regardless. I think thinking of internationalizing these businesses, again, back to that theme of we exist in complicated, difficult markets. This is not California, right? We're not in Northern California at all. So it's a difficult market to work in. We can't scale across the state borders from California to Nevada or whatever, and then access another 49 states. So here it's much harder, but there is a path, and the path includes really thinking about how do I aggregate the region as a whole. I think back to that theme about whether it's UAE, Saudi, Egypt, Turkey, etc. The point is, how do I access multiple markets and to embed that day one into your thinking as you kind of look to invest and if you're a founder looking to scale.
Okay, great. We talked about the life stages, the life cycle of a startup. We talked about great stuff at early stage, then it all sort of goes a bit quiet, a couple of players down. Let's take a sectorial view, right? So to create a thriving ecosystem of startups, right?
Yeah.
You should be a bit cognizant or conscious that you don't get a bias towards one particular subsector, right? We have, fintech has sort of captivated the imagination of this part of the world for right or wrong reasons. I'm not here to get into it. obviously we saw some e-commerce players, right? And we continue to see a few of them come up. Obviously, a couple of them have become fairly big. So a lot of people might get worried and scared away by saying, oh, do we want to take on X and Y? We saw obviously quite a lot of food tech, right? Including international players coming into the market and sort of buying into some of the players. I've been very closely associated with food tech in Saudi Arabia, right? How do you see that? So where are the imbalances, if you see any, right? And where are you really seeing some interesting growth opportunities emerging as far as other sectors are concerned?
So I think maybe to kind of talk about fintech a bit and why it's so, and maybe a hypothesis as to why it's so kind of I don't know, over-penetrated or over-invested or whatever,
or
is the plurality of the,
just leave it
or is
attractive,
the majority of plurality of where kind of investments happen? I think there's a structural reason for that, which is even in the GCC, let alone like the not as developed parts of the market like Egypt. Turkey is different, but like let's stick with the GCC and Egypt. Financial services, whether they're B2B or B2C, are massively underdeveloped compared to other emerging markets or similar kind of markets that are at the same income bracket or development level. So we are still in the GCC, one of the most unbanked and underbanked regions of the world, and that includes sub-Saharan Africa, right? So access to financial services is still not as developed as it is elsewhere, which is like, to give an example, like Tabby. So I'm lucky enough to invest from my previous job in Tabby and seen that rise. Why does Tabby outperform, for example, or we think it outperforms most BNPL globally on NPLs and on growth, etc. Tamara as well. I think the reason for that is there is a massive under-penetration had been a massive under-penetration of access to consumer credit to households and people who were otherwise creditworthy. But because the traditional financial institutions are frankly a bit lazy, and because they make more money in B2B lending to other government-related entities, they don't need to do the work on the kind of mass distribution. So you had this swath of, creditworthy households, individuals with no real access to consumer credit, who when BNPL came along in the region, like, this is great. Like, I don't need to worry. I don't have to fill out 20 forms to get a credit card and pay and like do all, and it's expensive, etc. This works. As opposed to a lot of BNPL in other markets, especially in developed markets, where BNPL is really for subprime borrowers. So BNPL stepped in, had this massive explosion, filled a huge gap. That's why I think fintech overall, this sort of dynamic is why fintech overall, across the value chain of financial services, is much bigger here than elsewhere, because they're filling real gaps in the market that in other, both emerging markets and developed markets, the more traditional financial services institutions have helped fill. So that's kind of my thesis.
So Khaled, you and I can have 2 episodes on this, right? I'm highly opinionated on these topics. Like you, I saw the early stages of Tabby firsthand. I've known Hussam. As a matter of fact, I'll even go on record. We were the first. I used to work for the Al Futtaim group at that time.
Okay.
And actually the first marquee, if I may say, the first marquee client that Tabby signed was the group, which was Al Futtaim, which included IKEA, Marks and Spencer's, and so on and so forth. I heard part of your hypothesis, and I don't disagree, right? So I personally don't think Tabby Tamara filled any gap in the market that existed. I think what they did was they unlocked a latent need, which is they made the consumer journey, specifically on e-commerce, a lot more elegant, right? In terms of checkouts, right? Vast majority of these people are credit worthy in any case, and which is why you're seeing low. And a lot of them actually have credit cards, right?
But the friction is part of the gap at the checkout, because you used to be able to say, with your credit card, at checkout, turn to installments.
It's a horrible experience.
But then you have to call the bank, or you have to kind of that is that.
If Apple Pay would have come 2 years earlier,
with installments,
with installments, right? Or even if it had come in this way, because Apple Pay wasn't there at checkout on mobile, because it was expensive to integrate, so on and so forth. I think the story could have been different. But let's keep that for another episode. Sure. My view with fintech today, and this is my bugbear with fintech, being part of fintech, is we're really not solving some of the real problems that exist in the market here,
Yeah,
right? We're not really addressing financial inclusion or the underserved as far as the SMEs are concerned. We're really not servicing the blue collar. I think there's some very good businesses which are now coming out on earned wage access. You know, there's a play on BNPL called Remit Now, Pay Later.
Yeah.
And it's sometimes actually, I feel bad for the remittance players in the market who are actually, in my language, the original fintechs.
Correct.
Right?
Yeah.
Who allowed money to move quite efficiently, right? Cross-border, quickly and safely for the vast majority of the people who unfortunately are the disenfranchised group. For some bizarre reason, and well, we don't say some bizarre reason, for some reason that we all know, they have not been able to evolve into, you know, more fully fledged fintechs. Because otherwise you can build a whole plethora of products around that
remittance
core remittance and wage processing.
Yeah.
Right. And most of them process wages for people who are in the low income segment. But as I said, let's park that for another segment. I don't get many people on that couch who can talk about some of the other sectors, right?
Sure.
So please tell me a little bit about
other sectors that like we're particularly excited about. So another thesis we have is that, and this is reflected in some of the companies we invested in already and some more we're doing going forward. So we really like, and we're struggling to come up with a good name for it, but really it's like private label, to give you a mouthful and then we'll come back. Private label, omni-channel retail, meaning people building their own brands, cross-sector, right, different kind of segments. That are so their own kind of private label. So we've invested in a company called Iowa, which is in the eyewear space, and they build their own kind of optical kind of glasses. But the key thing is they do both online and offline. And the offline, so they have retail outlets. They have like a large number of stores across the GCC now, and that drives a big chunk of the revenue and the profitability overall. We think that segment is super interesting.
So I was very similar to Warby Parker.
Similar, but much better unit economics.
Okay.
Again, great. I mean, like we talk about, like without disclosing numbers, I think one really interesting thing about the region, and talk about different sectors.
I'm a big fan of Warby Parker when it came out, by the way. So
different sectors, whether it's fintech, you know, we talked about Tabby Tamara, Iowa, similar to Warby Parker. In Saudi, you had Jahez and Hunger Station and all the Delivery Hero businesses. All have much better unit economics than their equivalents elsewhere in the world, which is an interesting kind of thing to think about, but we'll kind of park that. But on sectors, yes, I think there is a huge need to build locally sourced brands in different subcategories of retail, whether that's fashion, whether it's eyewear, etc., or furniture. You know, HomeSmart is another business to do that really speaks for local requirements and has a much higher gross margin and an offline and online footprint. I think that that's a super under-penetrated area. Nobody really thinks about, because we don't really think of it as tech. You know, even if you think about like Iowa, which was early in that journey, Iowa started purely offline as a marketplace, like selling third-party products, but evolved into that, saw that kind of opportunity. So I think that is a huge area to look in, but it covers multi-sectors. So whether you're doing kind of mother and baby, whether you're doing fashion, whether you're doing luxury fashion, whether you're doing sneakers,
furniture,
you know, but there is something within that to touch, because the region in terms of, and I was looking at these stats, but they're hard to come by, we consume a lot more global brands than the brands we make locally cross-segment.
Yep.
And that, as we start to understand our consumers better and better through data, and we have a little bit more self-confidence, I think you'll see so many more founders build for kind of local consumption in an interesting way. That's a big, I'll do like a big bet on that. The other is within food. I think the first wave was the aggregators. I think that's super interesting. I think the new wave is really, we're investing in a business called Calo, which is, indicative of what we believe in. So Calo does vertically integrated healthy meal subscriptions. So they own everything from the kitchen to the customer to the delivery. And you're able to kind of really customize your mirror for your healthcare journey and what you want. And I think that's a super, super interesting vertical. Companies absolutely on fire. And there are there are very few similar businesses like this globally. So why does it work here? Is what's because it fits that kind of local brand idea. It's a kind of conceived totally locally. And number two, it's this kind of vertical integration where you're basically like control the entire journey of from the kitchen to the customer. So that's more around that I think is interesting. I think there are some derivatives of food that could be interesting, but not clear what they are yet. I think within fintech, I mean, just to come back to that, what's interesting about fintech next is whether you call this fintech or not is stuff around capital markets. I think that's going to start because and we invest in a business around that, but we haven't announced yet, and the founders would kill me if I disclose it.
Okay.
But basically,
they're in the capital market space.
Yeah. So
and we're seeing more and more side, wealth side, where.
It's more in the public markets, local public markets, without kind of giving too much away and getting in trouble with the founders. But basically, as volume deepens specifically in Saudi, so this is potentially a Saudi only play, one of those kind of exceptions. But it's happening also in ADX and the DFM as volume and liquidity deepens and just the number of businesses go public. And that's the other quiet revolution happening on the back end that we didn't talk about. So many companies are going public, traditional businesses, future tech companies, everything like across the board. And you're getting a lot of capital inflow, both from retail here and institutions here, as well as globally coming into these markets. With that, there's a lot of technology opportunities to help serve these markets, increasingly so. So I think that's a really interesting derivative. And the other one is derivatives of consumer credit. We said consumer credit has really expanded in the region. So you need ways to serve that, right, in different ways. And that's another derivative. So that's kind of within the fintech space, I think the coming wave that's interesting. We also, I think that we're on the cusp as a sector of really revolutionizing healthcare towards personalized medicine. I think this is a global phenomenon. I think it's coming to the region. I think it's going to come in different waves and forms. There's, some early indications are companies like Blue Care, Ali Hashimi's company, which is super interesting. But I think there's a lot that's going to happen in that space where the healthcare journey will be digitized at the individual level, meaning you will want to monitor and control your healthcare very individualistically rather than just kind of broadly. And I think the delivery of that care is going to change. And I think we're on the cusp of finding that. And that's a big sector for us. I think we're really looking at how do we play in that space. Don't see many companies there yet, but they're there. Lastly, I think, for lack of a better word, prop tech, like, real estate, I think that's
I think there's a very interesting angle around tokenization and stuff, and that comes exactly, in, right?
Yeah.
So tokenization of real world assets and then real estate, I think there'll be a huge opportunity there.
The last area is, I think, increasingly Saudi, UAE are becoming more global hubs than regional hubs.
Okay.
For a variety of reasons, kind of we mentioned there's capital, what's happening in the rest of the world, etc. What that's doing is creating interesting teams that serve more global markets, and I think we're seeing more of those. And these are cross sectors, but their natural markets are not necessarily local. And I expect to see more and more of those types of companies emerge. When before they were not really viable, they had some adverse selection, meaning companies you don't really want to invest in are the ones that are, popping up here from London or, the US saying, we're here, can you give us some money because we're solving a problem back in the US? They tend not to be good companies. But I feel it's changing, and a lot of these companies want to solve big emerging market problems, which is kind of new. I've not seen that before.
No, and you're right. I've come across quite a few in the last sort of 12 months, if I might say so, who are looking at this region, but this region from a slightly more macro perspective, right?
Exactly.
So again, that the whole the convoluted geography that I drew then becomes quite interesting. I'm going to ask you a straight question, Khaled. Why do you guys not invest in women founders?
Well, we do invest in women founders.
Come on.
It's not
the sector invested a paltry 19 million out of the 4 billion on female founded businesses, right? We've gone backward year after year.
Yeah.
Why?
Okay, this is gonna get me into trouble because my 2 partners are women. So like,
well, no, I don't want to get you into trouble,
50% of our partnership of the firm is led by women. So like, and we do invest in women. The question is the lack of funding that women receive from VCs generally, is that a function of is the reason there less women receive funding from VCs because there is some type of prejudice or some type of screen being applied at the time of funding, so women founders approach VCs?
I hope not.
Because that, or is there something earlier in kind of the value chain of the formation entrepreneur where women are not founding as many companies or reaching the stage where they can raise money from VCs? My argument is it's earlier in the value chain. I think there's something inhibitive happening earlier, where whether that's traditional gender roles are still a thing especially in our part of the world, or whether it's kind of other factors. It's not at the time that it gets, I think, primarily to the VCs, because for us, we want to make money. I don't care who comes through. If it's a great founder, it's a great founder. It does not matter. You can make an argument that there's an inherent bias against women, maybe from VCs, but I just don't see it. I don't see it from my peers.
Yeah, let me try and say it. So firstly, I actually had the managing director of something called Start AD. I don't know if you know them.
Yes, yeah, of course.
Okay,
yeah.
so Professor Jagannathan, right? And the statistics he gave in terms of the number of women participating in these incubator workshops and startup workshops is mind-bogglingly high, right? So somewhere down the journey, so these people are all coming into this early stage, educating themselves on what a startup is. Some of them are actually even taking some ideas, but then something sort of happens. I do not know what happens, but it falls on the wayside. I've had a number of female founders who have sat here. They've obviously shared their opinion. We can go back in time. There is a view which is that there is a template of a founder, a successful founder. And again, I'm making this up as we go, which is in the back of the minds of the VC. And that template, I'm sorry, is sort of driven by very sort of masculine values, and that's embedded itself into the template. Not because everyone's forced it, but because habitually it goes, right?
Which is you mean an inherent bias?
It's an inherent bias which you don't wake up every morning thinking.
It's subconscious.
It's at a subconscious level. It's like how a professor sat here and said it. He says, "Why is there a coffee holder in every car and not a handbag holder?" Right? Because women are driving as many cars as men as, right?
Yeah.
But the cars were originally designed largely for men because they were the ones who started driving initially, and therefore the car is ergonomically organized for men.
Well, not to nitpick with the good professor, but like you can put a handbag on the chair, but
But if there's someone sitting next to you, then it's on the floor.
Well, you can put it in the back.
Well,
but like it's like I think there is some. I mean, I don't know the professor. I'm sure he's great, but like I think there is something in academia where, especially in the past 10 years, where they want to judge inequality of outcome and equate that to inequality of opportunity. The question is today and I'm not a woman, so I'm careful to how to speak about it. Is there inequality of opportunity for women, or is it just an unequal outcome? So if there is, where in the chain is that inequality of opportunity happening?
I don't know. And that's the question I posed to you guys, because as venture capitalists, you guys might be looking, right? Because maybe you guys are missing out on great business ideas because it just doesn't fit the template that you guys are used to.
I hear this a lot, and like, I think I'm primarily driven to make money for my investors.
No, I agree with you.
And if you see that there's a path towards making money, we will. I think this inequality of outcome is driven by something breaking earlier in the value chain, right?
Okay.
Earlier in the process, Where, how, I don't know, because I don't go that early. So it's like, it's as early as when you're in thinking of starting a business. You're let's say a person at a corporate or in a kind of like a non-entrepreneurial role, and you're thinking about taking an entrepreneurial role or starting a business or co-founding a business. Is there something that's inhibitive at that point from kind of societally constructed that's more inhibitive to women taking that plunge? Maybe, and maybe that's what needs to kind of be fixed. Is there something else? But is it a funding problem? I think the funding is just the last step on the chain, because if anywhere on the chain, people would be naturally averse to being a bias, is the VCs, because the VCs are the most incentivized to make money no matter where it comes from. Does that make sense?
I wouldn't question that, and I'll say that again. I don't think I think the view here is you obviously determine where you make that money, right?
Sure.
And my question is there something potentially? I'm not suggesting anything.
Yeah.
Is there something potentially wrong in the determination process, which leads us to what, you use the word subconscious bias, or I use the word subconscious bias, right? And do the templates need to evolve? Because I can put a VC on the spot, and I will never put you on the spot to say, if there are two equal opportunities sitting in front of you and you can only invest in one, and here is a male startup founder and here's a female startup founder, right? Is the process just naturally inclined to go towards male because you say 99% other successful founders are men? So if I just go through the process of elimination, if both businesses are the same, the man will win 99.9% of the time than a female, right?
Yeah,
and that's kind of the experiment to be done, in my view, right?
Yeah,
that's how you would to prove the bias.
And I think then that's a kind of experiment that needs to be run. I mean, all I can say is I don't think it's built into our framework. I think there's bias. Bias is part of like the human experience. I mean, it's hardwired into our evolutionary biology. And you can try to control for it. And, for us as a firm, I think like I said, like about 50% of the partners are women.
That's impressive.
Well, we added one part, so it's like 40% now, I should say, just to be 100% accurate. And then my most successful investment ever was by a woman founder, Hande Stillinger, who is the founder of Insider. Today, it's by far the biggest kind of biggest dollar potential outcome that I've ever invested in. So.
Okay. No, I get your point.
So
if you don't have the answer, you don't have the answer.
I don't negate the premise that there could be subconscious bias, because it's possible, because it's subconscious. So how do you have to kind of run, like as you said, like a double blind experiment to kind of figure out where is that bias. But I think it does fall on balance. I would think that we are much more incentivized to back anyone who makes money, and it's earlier on in the chain when it's less about kind of the profit motive, that other factors can come in and pollute that kind of purity of objective.
You could be right, or it could be a collection of all of that, right? And I
probably
think,
it is.
Unfortunately, it is.
Yeah.
All I'm saying is, and we move on to the next question, is I think we are, the investment into women is just obnoxiously low, if I might use that word, right? It's not because they're not coming up with good enough business ideas. It's not because they're not talented enough to run businesses. Course correction needs to happen. And I think if there needs to be something done more overtly, I do not know what the answer to that is. It needs to be done, because I do think that it is not setting the right precedent downstream for a whole cohort of young women who might want to be business women entrepreneurs, who are all looking at this number and saying, something, my chances of success are very, very small, because, they can only look at data at any point of time and say, something, I'm better off not doing it and let's just get me the job. And again, we go down that sort of vicious cycle. That's kind of what my fear is. And I've come out of other demographic cuts and splices where I've seen that play out, where people have just been, demotivated to do something.
Sure.
So again, whatever that is, maybe it's something more institutional. I'm not suggesting Nuwa Capital has to solve the problem, right?
But it's interesting. I think what would be interesting to do is like bring a panel of women who've succeeded.
Yep.
And then, so like Hande Schillinger, founder of Insider, or Mona Ataya, founder of Mom's World. I'm just listing my portfolio companies. Or we have co-founder of Valio in one of our companies called Nadine. And ask them the question, right? You ask them the question directly. And
I'm
ask the successful founders. Because I think you can say like, for people who have not been able to raise, how much of that is bias, but how much of it is not? I think on the balance of those that have succeeded, how do they feel? And I think that would be an interesting discussion.
It will be an interesting. Yeah. I've had a couple, and I've heard different opinions. Right? I've heard one in my first season, one particular founder, and she said, "Hey, I don't think this is a women thing. I just thought that sometimes women don't present ideas well enough, and so on and so forth." I don't necessarily agree with what the lady said, but it's her opinion. She's allowed to have an opinion, and she's raised money for her business, right? We've had others who've actually said, no, it was really, really tough. And, I always felt that I had to go 150 miles an hour to compete for someone who was just running at 100 miles. So we are. But I might take you up on the offer. I might ask you to introduce me to one of your founders of the portfolio company. We'll pose them the question. Let me come back to Nuwa Capital, right? I'm sorry, we've talked about the macro environment, although you've been sharing a little bit about Nuwa Capital. Tell me what makes you guys different, right, in terms of the growing number of venture capitalists there are in the market. And I'll kind of sort of plug the second question in it so that it gives you a bit of a run. How do you guys operate any differently, if you do so, with your portfolio companies?
So I think that's kind of part of the differentiator. We've been in the space for a very long time in these types of markets.
You don't look that old.
Yeah, well, it's all I've ever done. We're good or bad, like, because that's not necessarily a good thing. So I've done this almost straight out of college.
Okay.
By mistake, but I just fell into this, and done over 300 odd investments, 330 investments. So trying to kind of take the learnings to kind of build something new when we set up Nuwa Capital. So before this, I used to run Nuwa Capital, help set it up, and then raise the money, and I was the managing partner there. Then I kind of stepped out with some of the team to kind of set this up. And we want to take the learnings of the 16, 17 years to do that. So the first thing we want to do was understanding that Saudi was a big coming story, especially in 2020. And it's a difficult place to operate in. So we brought in a Saudi institutional partner to be our anchor investor, but also to be a shareholder with us in the GP. That was important. And what they do is they help unlock Saudi opportunities for our portfolio companies in an actionable way. Number two, we're super focused on value creation, or kind of supporting our companies in a meaningful way. We've not cracked it, but the way we've tried to do it institutionally beyond the high level is as follows. One of our partners, who's also with us at WAMDA, then had several roles since, is a gentleman called Nitin Reen. He's an operator, he's ex-Rocket, ex-Maghribi, and he really works with our companies on an operating level to kind of help solve their problems. And he's supported by a number of part-time subject matter experts in specific domains: recruitment, growth hacking, marketing, tech, product, UI, UX, that we make available for our portfolio companies on a pull basis. The companies use them as they see fit. And, I think that's one thing that our portfolio companies really, really appreciate. So they use it. And we want to figure out, as we grow our AUM, how do we help kind of deepen that? And that seems to be kind of a key component. We try to be very quick in our responsiveness, although we fail on that, I think, a lot. And we're trying to kind of be better and better on how do we get good feedback quickly and kind of, pass or move something forward very quickly. I think that's built into our who we are, but the problem is a volume problem. How do you kind of scale that? How do you do that very, very well? I think the last thing is that we like to think of ourselves as like multi-stage. We want to build the firm so it's not just one fund, but actually is addressing multiple stages of investment. So early stage through to late stage. So that's kind of how we're conceptualizing the firm. Not there yet, but that's how we also want to differentiate in the long run, to be able to take a company through its funding journey A to Z.
So that beckons the question. So in your experience, 300 odd investments, if not more, seen lots and lots of, if I may say, portfolio companies, right? What are sort of some of the common pitfalls that you've actually seen early stage sort of, early stage companies or startups sort of commit in this sort of a market, right? What would be your sort of, guys, be wary of these things?
I think one thing that's not discussed enough is founder dynamics, primarily the relationship between founders. So many companies fall apart on kind of founders not having a good sense of each other and a good way of working with each other. They make sense on paper, but then when they actually work together, that just does not work. That happens a lot. A lot of kind of infighting can be quite brutal. And if it's an early company, a lot don't survive that, right? And we rarely kind of talk about that. Similarly, you have bad founder-investor dynamics, whether that's with angels or with at the earliest stage or with the kind of early VCs, which is also quite destructive. So I think building a good kind of culture around, your co-founders and with your other stakeholders, namely the investors, is really important because it just sucks up a ton of energy and is kind of massively destructive. And I think it's rarely spoken about in our region because we don't like to talk about conflict and stuff like that. But I think it's important to shed light on. I think that's one big one. I think the other thing, which is a bit, shifting purely on kind of more technical side, which is that I think this idea, although it's changing to be fair, this idea of, high GMV, high transaction value, whatever you call it, that top line figure or revenue, it could be revenue, grow at any cost. But then with kind of terrible unit economics, then with the promise saying that once I get to a certain volume, I can turn a switch
it on.
And this is the Amazon playbook, but that worked like 30 years ago in a very specific way. And I don't think that works.
And at a scale which is not.
And at a scale that's kind of unprecedented. Or you're saying I'm going to launch new services that kind of, once I have scale, that kind of make it profitable. I think there's very few examples that have actually worked. But I think much more importantly and somewhat kind of intellectually, if you think the most basic part of unit economics, your gross margin, your gross margin, and I was thinking about this recently, is really a reflection of the value of your product or service, in the sense that it combines within it the demand, how much pricing power you can command, right? The more pricing power you can command, the higher gross margin, versus how effectively you can build your product or deliver your product or service. So it encapsulates within it the actual value of your product/service to the market as a whole. So if you are constantly in a gross margin that's like 0.3%, or whatever it is, but it's much lower than your kind of relative industry, but you think you're doing that because you're going to gain market share later, that's actually, you should stop and think about that. Think that, no, actually there's something wrong on two sides of those stakeholders. The way I'm building this on my cost structure or my pricing structure, like it means that people don't want my service, it means I can't command price. So I think founders should really think about that a lot, like deeply. And then think about the next layer of unit economics, which is like, next to marketing, whatever, etc. But that first layer saying, I am selling, for very first principles concept, I am selling X, how much can I extract to me from selling the X, net of kind of just buying it or like reselling it. And I feel that was lost a lot in the past few years.
Largely because they were just interested in the top line.
In top line, I think there are some
about extracting.
I think there's some bad examples. Uber, that
we had a few bad examples in our region too, and some of them are still celebrated. I won't get into the names of those.
Yeah, I think B2B marketplaces a lot look like that.
Yep.
Frankly, and that's and they still have value to create. I'm not kind of negating that whole thing, but I think I would suggest founders in that area really think about how do I augment my product or service, or, so that It reflects in that margin.
Yeah. And I think it's a fair question to ask. And I think it's a fair question that startup founders should ask themselves quite regularly, right? And because, their business models evolve in the sense that they respond to changing sort of circumstances around that. Khaled, I'm conscious of time. Sure. My last question to you, right? Sitting from Khaled's view, Nuwa Capital's view, what do you see 2024, 25 hold for ourselves? I'll park two things. Yes, there's a lot of excitement around the market that IPOs will continue even in the startup space. I think there will be some consolidation plays, and there's a whole secondaries game which will come into play. Outside those three, how much of a bounce back do you see in 24 in terms of VC dollar deployment? Do you not? Are we going to get a richer mix of LPs and less of these sovereign LPs coming in and then encouraging VCs to deploy?
I think the more kind of diversified LPs we will see, but at small dollars. So you'll see a lot of kind of global LPs do like $1-2 million, $3 million, like small tickets.
Okay.
But I think the big institutional allocators will start trickling in towards the end of the year as the market settles and they rebalance their kind of global allocation. So I can see more LPs kind of, it's slightly self-serving. I want those LPs to enter the market so that I can raise from them. But I can see how there's a narrative that can be formed around MENA that was LATAM 8 years ago, or Southeast Asia, similar kind of period ago. So I think I can see that dynamic emerging. You have big, interesting companies emerging from the region. And I think you'll see more of that towards the tail end of 2024. I think in terms of VC deployment and dollars deployed, I think will be flat, if not driven by, or increased, but driven really by mega deals in a way. I think we're such a nascent market that the sample size is not reflective. So one big deal can poof, like you can raise $500 million, suddenly it's like 20% up. That could easily happen. And you are starting to see large businesses that can absorb $100, $200, $300 million ticket, especially if you include secondaries. Right? So I think I would say flat, if not increased, driven by mega deals at the end of the year. I would say there's going to be less VCs numerically, as in VC shops or fund managers, because I think some will just naturally exit the market because I think they, for whatever reason, I think it's the party may stop for some, but it was kind of fun and I don't want to do it anymore. Because it's a cyclical business, so people, when the cycle's up there, it's fun, and then when the cycle's down, it's like, I'll go back to do something else.
Are startups going to start accepting revaluations?
I mean, they already are.
Are they?
Yeah.
I haven't seen much publicly happening.
I mean, nobody likes to brag about it, but it's. I mean, nobody's gonna celebrate it, right? Like,
you're already seeing that, so they are willing to take corrections, not just flat. Because I think I was seeing a lot of flat. We'll just continue to call it an extension of our Series B from 9 months ago.
I think you can have that if the company has great momentum, but companies that have kind of some questions, need to pivot, etc. You are seeing some revaluations. A lot of also the flat or those kind of flat rounds, or let's kind of put another convertible. A lot of that is driven by the VCs actually, who don't want to mark down.
Oh, I know. Yeah, exactly. Right?
So I don't know how much of it is the founders not accepting it. I think founders
want to keep the business alive.
I think when push comes to shove, actually, I think some of the funky behavior is driven by the VCs who would rather, because they have to raise again, right? I mean, that's the funny game here. So they'll say, no, let's do an internal continuation round. We'll do it like this instead of having a harder conversation and resetting the business, so that I can still show my books at like 2x or 3x NAV or whatever it is, or MYC or whatever it is. And I find dangerous because, and it's done globally. It's not, but in a small ecosystem like ours, suddenly if there's a big delta between what you're carrying it and then what the outcome is, just because you want to play that game, dangerous, very dangerous. I think that's what, but like I said, the dynamic, I think, driven by the VCs more than the founders.
Yeah, I agree with you. Khaled, I want to thank you.
Awesome. Thank you.
Thanks for coming in. Fun. I hope we were, as you said, you like a challenging conversation.
Yeah.
I don't know if I lived up to
Absolutely.
giving you the challenge.
No, very like it was good. Like I really liked the conversation.
All right. Well, so did I, and I'm fairly confident that actually the audience would enjoy it too.
Hope so.
This year, I am overtly spending more time than previous seasons talking to people who come from the investment sort of world, because I think it is going to remain a key theme, right, for people, who are either getting into the business or want to grow their business. Because, as I interact with more and more startups, and, for my sins, I've exposed myself from an angel perspective. I think one of the constant conversations I have with these people, with these founders is, we need to go and get capital. We need to get some smart capital. We need to get some good VCs to work with. We need VCs who can open up our networks, because, we want to be able to use the money for more than just money. So I think there's an important role for you guys to play going forward. There'll always be naysayers out there. I think you guys do a very important part of the role. One bit we didn't get into today, but maybe for another day, another time, is I think the role CVCs should play, because I do think that they don't play a good enough role in this market. But again, that's another episode another day, right? So thank you for coming.
No, thank you. I really appreciate that.
Have a good day and a good weekend, and I'm sure we'll talk more because we're fairly adjacent in what we do.
Fantastic.
Right?
Thank
so
you.
everybody, that was the managing partner of Nuwa Capital, Khaled. I hope you enjoyed the conversation. It was fairly frank. I wouldn't say it was no hold bar.
That's for the next one.
That's for the next one. Right. But with that, I want to say goodbye and thank you till next week.